In this week's video, we'll review some charts that can help us monitor the most important thing for 2015. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In last week's video, we covered some scenarios or setups that told us to be open to bullish outcomes. Stocks did perform well in the past 5 trading sessions, posting a 2% gain as of late on Friday afternoon. This is the present day S&P 500. We can see that it looks more like a full bore bullish look. This is the bullish period in 2009 rather than a full bore bearish look. This is the bearish conviction look in 2008. While the 2015 chart is still maintaining a bullish look, this little hesitation and V here is telling us that the moving averages in math remain vulnerable here, which we can see a little bit more clearly if we zero in on some shorter term weekly moving averages. This sideways look speaks to hesitation, and we have our blue and our red moving averages relatively close together. Stock market bulls would prefer this chart to morph into something that looks a little bit more like this. The bears would prefer to see this morph into something that looks more like this. Last week we used this chart and simplified things and said that if the S&P 500 in the short run could clear this level here, our 2064, that we would feel a little bit better about the probabilities for bullish outcomes. We did not clear that level. Thursday's high was 2064 here, and as of late Friday we hadn't cleared it. Other than using this level and these levels down here for bearish probabilities, are there other things that we can look at? The answer is yes, and we'll cover them in this week's video. This is the long-term NYSE composite chart that we've been watching for some time. This is the bullish breakout here above the 2007 levels. That's the good news. The bad news is this is a monthly chart, and we've basically been going nowhere for several months. In fact, you really can't find anything that looks anything like this going back all the way to 2004. This hesitation here is telling us that risk is higher right now, and we need to pay closer attention until we get either a bullish or bearish resolution. From a good news perspective, the German DAX was able to hold its bullish breakout that we covered last week. However, the S&P 500 has still failed to break above this line here. As we discussed a couple of weeks ago, this is a 78-day move from here to here. If we had somewhat of a symmetrical pattern, this right shoulder look over here could complete as late as February 7th in getting a bullish breakout here. So there is some hope for this somewhat confused and messy looking pattern still. Now we'll shift gears to the most important concepts for 2015. Sometimes we can learn more about risk and reward by looking at intermarket relationships or ratios. So we're looking here at stocks versus bonds, or SPY, the S&P 500 ETF, relative to long-term treasuries, or the TLT ETF. The ratio is in black here. These moving averages help us discern trends. You can see the ratio was rising here in 2008. When it rises, that tells us that the demand or conviction to own stocks, or SPY, is higher than the demand or conviction to own TLT. That trend reversed here as stocks started to drop more rapidly during the financial crisis. So when this ratio is falling, it tells us that the demand or conviction for TLT is greater than the demand or conviction to own SPY. So this is what risk off looks like. You can see our moving averages and our trends have relatively steep and bearish slopes going against stocks and in favor of bonds. Conversely, when investors become more hopeful about future earnings and positive economic outcomes, the demand for stocks starts to pick up relative to bonds, and you can see this is where the stock market, the S&P 500, bottoms in March of 2009, and we go from a full-bore bearish look to a full-bore bullish look, which looks quite different. Blue is below red here, blue is above red here. The slopes of the moving averages are down, prices below them. The slopes of the moving averages are up and prices above them. How can all of that help us in the present day? We're looking at the same ratio now in 2013 as the stock market is rising. For the most part, the ratio agrees 100% with the stock market. This is a full-bore bullish look. We've got steep slopes here. Everything looks good. 2014 looks quite a bit different. This doesn't really look like a full-bore risk on or full-bore risk off. In fact, we have low conviction in terms of the battle between stocks and bonds, and you can see our moving averages are going below and above, slope down, slope up, slope down, and we have a flattening out here. So 2014 was much more difficult in terms of discerning where people wanted to be relative to 2013. This indecisive and flat look here is telling us that the risk-reward ratio of investing in equities is lower here than it was here, which tells us that risks are higher until this clears up one way or another. The way that we handle this is when you're indecisive here, you give the prior trend the benefit of the doubt until proven otherwise. That's a valid assumption because it's not unusual for a rising trend to consolidate gains and then start to rise again. If we fast forward to the present day, we have now somewhat passed the point where we give this bullish trend the benefit of the doubt. Why? You can see here we have a positive slope. This slope is now rolling over in a bearish manner, and rather than having consolidation in the ratio, we now have a lower low. This low here is lower than this low here, and a lower high. This high here is lower than this high here. So now we're at a point where we're starting to give bonds somewhat of the benefit of the doubt until stocks can prove otherwise. So how will we use this now? If this ratio continues to move in this direction, we'll continue to scale out of stocks and into bonds. Conversely, if the ratio can get back above the moving averages and break above this trend line here, so the ratio moves into this area here, that would allow us to be patient with our stocks. So we'll let the market and the evidence guide us. We can make the same risk-on versus risk-off argument looking at the ratio of stocks to the US dollar. This is 2008, relatively early in the year. This is what risk-off looks like with the stock market falling. And this is what risk-on looks like after the stock market bottomed in March of 2009. Looking at the same ratio in 2013, the ratio aligned with the stock market. Stocks were going up. This has a full-bore bullish or risk-on look. And things continued to look pretty good until roughly June or July of last year. And then, like the chart of stocks versus U.S. Treasuries, this starts to morph into a more concerning or risk-off look. Again, we have a lower high relative to this high. This is a lower low relative to this low. This is starting to look like a downtrend in favor of owning the US dollar over growth-oriented equities. So these charts need to change for the bulls. This look here needs to morph back into something like this for us to be more confident about holding our stocks. If it can't and it fails again up in this area here, like the TLT chart, then we would be more willing to start scaling out of stocks further and into bonds and possibly the US dollar. If this ratio can break this trend line here and move into this area here, then we can be patient with our stock-based ETFs. We'll close by putting some fundamental context around those charts. We've been over this before. This is how we morph from a bull market to a bear market in a more traditional inflationary boom and bust. When we see TLT, treasuries in the US dollar, posting such gains in a relatively strong leadership position, that's telling us that we may be in a deflationary boom. We're in a situation now where there's a certain percentage of market participants that don't really believe and have low conviction in this and believe that the Fed has created all this with low interest rates. In terms of how things might play out on the SPY relative to TLT and SPY relative to UUP charts, we could have a situation where valuations versus growth becomes problematic, or the market gets spooked by the threat of the Fed raising interest rates and stocks start to drop, causing the economy to slow further, and then we move into a deflationary bust. Under that scenario, stocks become the losers, and most likely bonds and the US dollar would be the winners. If we move from the current look to a situation where economic growth picks up, inflation picks up, and we eventually morph into an inflationary boom, bonds could get hit hard with the threat of rising inflation, and in the intermediate term, stocks would most likely win. The third scenario is we get more of the same and we continue along a deflationary boom path where your leaders include U.S. stocks, U.S. bonds, and the U.S. dollar. Since some of these outcomes are binary in nature, we'll keep an open mind, and we'll use the charts in this week's video to help us make better decisions from a probabilistic perspective. With quantitative easing being announced across the pond this week, does it make sense to move into European equities? The answer for us is not yet. This is the Euro Stoxx 50 as of Friday, January 23rd, the FEZ ETF relative to the S&P 500 or SPY. You can see it's still clearly in a downtrend against FEZ and favoring SPY. So we would need to see this chart break this downward sloping trend line and complete the 3 steps needed for a trend change. Notice the slope of this is down and the slope of the blue moving average remains down. It may change, but we need to see more than this. Looking at it another way, would I rather own European equities, FEZ, or would I rather own TLT? Also in a downtrend favoring TLT at this point. And to make sure we're covering all our bases, we see the same thing when we compare FEZ to the US dollar. Slope of the red down, slope of the blue down, price below both. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.